All right, boom, we're live. Welcome back, everybody. Thanks for tuning in. This morning, we are recording Tuesday, the 5th of August in the morning before market open, or at least that's when we're starting. And I've got with me the wonderful Andrew Page from Strawman and, of course, Patrick Polk from our very own A Rich Life. Gentlemen, nice to see you. How are you?
I am very well, thanks, Claude. How about yourself?
Yep, very good. Excited and a little apprehensive, of course, for the earnings season to come, where we get so busy for so long, and it feels like a bit of a marathon trying to just take so much information in and then report on the bits that matter. But actually, what we've just finished off is sort of July reporting season, which is the quarterlies for some of the smaller companies. And also, you typically get those earnings updates, sometimes downgrades, sometimes upgrades. But, basically we're at that point now where the companies know essentially more or less what their results are going to be that they report in August. And if they're wildly different from guidance or what the market is thinking, then that's often where you get an update that has the good or bad news in July.
Confession season.
And so today we're going to talk about three small caps, Laserbond, and also Praemium, which was it was a reader request actually. Initially got on our list because a supporter of A Rich Life wrote it in as a small cap mailbag suggestion. And then also I'm going to revisit Australian Ethical that had a bit of a quarterly update, which we've previously covered. In fact, we covered in the very first ever episode of the ASX Small Cap Wrap. So before we get into it, any statements that are advice under the law are general advice only. The author has not considered your investment objectives or personal situation, or the speaker. Any advice is authorized by myself, Claude Walker, AR1297632, authorized representative of Ethical Investment Advisors Proprietary Limited, AFSL 276544. And just please keep in mind that none of this is actually intended as advice. Like, these are just thoughts. We are sharing our process as investors, our mistakes, our wins. And so you shouldn't be making any investment decision based on, what we're saying on this podcast. This might be an idea for you to go and talk to somebody else about, or do your own research and, get the appropriate advice that you need. But just, don't do anything crazy. No silly stuff.
I'll jump in here with a quick rant.
Yeah.
If you are basing your financial decisions on what you've heard on a podcast, look in the mirror, for God's sake. Not just this podcast, but any podcast. I mean, it sounds like it's a diss. It's not. You get some great ideas and hopefully we'll serve up some good insights. But I'm really fond of saying you can borrow an idea, you can't borrow the conviction. You hear a couple of guys talking about a stock that they like. It's contagious and you want to buy it. But it's long after this podcast is finished, things will change. Our opinions will likely change, and it's sort of like you need to own these ideas. So hopefully we can get your brain sort of turning over, but you got to run with it, right? It always sounds like butt covering, we kind of want to give our advice, but it's not advice. No, it's not advice. And if you see this as advice, take a look in the mirror.
Yeah, so
I'll say it more bluntly than you.
The proper advice that I give is, I'll send an official buy recommendation, which is the actual rare bit of actual advice, and then we'll give updates. This is to supporters of the website, and then we'll give updates. Of course, if my view changes, then I'll put out the hold recommendation or the sell recommendation, and then only after that would I sell myself. But that is for that's like an official recommendation. That's actually when you are trying to say something.
It's a paid service.
Rare. Most of investing is just this is ideas. We're keeping abreast of things. We're monitoring companies that we've already made a decision on at a different price in the past. So, ultimately that's what this is. And for sure, we still get to meet great people with it, because there are people who we're speaking to who are the people that are actually looking after themselves. They're not doing silly things. They want to be part of the conversation. And I get emails. We all get contact from listeners. So thank you when that happens. We get, listeners that are themselves clever investors. There are plenty of people listening to this that are far better invested than I'll ever be, because you have some real stars out there who are not fund managers, because the best results you get, the really best investors I find that I've ever come across, they don't want to manage $100 million. They'll manage $5 million of their friends and family or whatever it is. And then that'll grow to $50 million over time or something. But the very best ones don't want to have to manage other money because that has a terrible impact on the actual returns you can achieve. So, that's a very small group of people in society, but they really exist. And by and large, they're the people that have kept us in business for the last 5 years. So thank you, everybody.
Yeah. I think the other thing is that people, in a podcast like this or an article you read online, the exception obviously being to our paid supporters, people tell you when they like a stock, but they never tell you when they sell a stock. Yeah. That's something you got to work out for yourself. Yeah. People only ever want to talk about the positive stuff, and they usually will talk to you about it after it's run 20, 30, 40%. It's only really when you're using one of those kind of paid services like that that you actually get access to ideas before they take off, and you actually get told, hey, like, we're not calling this a buy anymore, or actually we're calling this a sell now.
Yeah, exactly. And also it's only in that scenario when it's like a formal kind of thing that you're getting timely advice either. So for example, over the years, I used to go on Ausbiz at a regular basis. And part of that, what was taxing about that was that if I was talking positively about a stock on one day and then things changed and my view changed, I'd have to try and remember to take the opportunity when it came up later to talk about that stock to say, hey, actually my views changed. I said this previously. This is now my new view based on this new information. That wouldn't always be timely. Like I'd talk about the stock, something had happened, and the next chance I'd have to talk to that same audience about that stock might be weeks or months later. And so it's not going to be timely. That's why, you can't basically base, podcasts, TV shows, all of that kind of stuff. Like this is a point in time discussion that might not apply. And so ergo, it's really just sharing research and ideas in that spirit. Let's actually get into it, because I think one thing we can do is cover those small cap stocks that basically no one else does, and certainly not with a degree of sophistication. So the one I wanted to jump into at the beginning was one that at least I know you and I, Andrew, have both followed for years. Pretty sure you have it as one of your sort of active Strawman positions. Laserbond. Is the Laserbond share price too low? Is what one of our authors, Growth Gauge, who also has his own blog, by the way, he wrote about Laserbond, which he himself has followed for years. And I had a similar experience following it for years. I bought it. I held it previously. I actually previously recommended, I hate to say this and hate to have to confess a loss to everyone, but since it comes up, I previously recommended Laserbond because it's a little industrial company that seems to have a genuine, little niche that it has a competitive advantage in. We're talking about its main innovation is like using laser cladding to make tool bits and parts stronger and last longer. And also their main offering is actually that they now have grown to a decent size where they have fairly close, they have distribution networks in several states. So therefore the turnaround time, if a mining company, they need to get their cog bit hardened or whatever it is, the gear needs to get its regular maintenance hardening so it lasts longer, then it can be out, fixed, and then back as quickly as possible, because any time that they're missing this equipment could be causing delays and costs at the mine site. Just as if they can extend that equipment's life for several years, these mining equipment and these parts are so big and so heavy duty that they cost a ton to actually replace. So if you can, the economics make sense if you can extend the life of that thing. So that's what I liked about Laserbond in the past. I think we all liked about it. It tended to have a genuine innovation that it was monetizing. Now, to catch readers up to the story, both, for the people who've lived through the pain themselves, but also for those that really just have never come across this little obscure ASX small cap stock, Laserbond has had a rough trot. Like things didn't go to plan. For a while there, it was growing its profit. It has 3 divisions. It has it has the services division, it has the product division, and it has the nascent technology division. The product division is when they've basically started producing products themselves, which are treated with their laser stuff. So idea, just new products trying to compete in the market. And then there's also the services one, which is what I was talking about, the maintenance, making other people's products last longer. And essentially they were all going up for a while. The technology division was where they try to license their technology. That's been a bit of a unsuccessful division, with many promises that they made saying, oh, it's going to be now, just constantly delayed. They've really, in my opinion, just completely damaged their credibility with the lack of delivery on that on that one. But as you'll see in Growth Gage's article, the product revenue's been going down for the last few halves, and services been going up. The technology's been flat to down. So with all that basis, the argument was like, turnaround success, is it possible? Because the share price has come right back down. And look, it started coming back up again now, but it got really quite low for a while there, all the way down to under 40 cents for quite some time. And if you look at the last 5 years, the share prices range between about $1 and 40 cents. So yeah, is it a turnaround potential? And if so, have we gotten our little chomp out of it when the share price shot up recently, or is it actually potentially more to come? Andrew, over to you. Please tell us your history with Laserbond and what your thoughts on it are.
Yeah, I think I'm down from when I added it to the scorecard on Strawman. I'm not as apologetic as you. I tend to lean into my mistakes. One, because they're unavoidable. Like you show me an investor who hasn't made a mistake, I'll show you a liar, right? Like, so it's just you're always, you beat yourself up so much about these, Claude. And I always think, do you really expect to have a strike rate of 100? Like, no, you don't. So you're being modest.
Yeah, look, I'm not trying to say that I'm mentally healthy. Like, I definitely don't think I am. And that's partly why I probably don't want to continue in this game of talking about stocks forever. Just like, I have been happier, like, just not saying anything and doing my trades.
And look, you're not, I don't need, you need me to tell you this, but you're not perfect, right? And
I know, of course.
None of us are.
I feel like, I want my impact on the world to be good, and when you make a mistake, necessarily, then that means the impact on the people who you care about most is negative, and that's what gets me. It's like, I don't really mind if I leave some scoundrels, worse for wear, but like, I want to be helping the people that are the people that support me.
Yeah, look, I say all of this. Hopefully, there's a message in it. But I mean, if you're out there listening and you're investing your own money and you're doing it with more than just play money, you've got to embrace the idea that this is a probabilistic game. I've always loved the saying from Peter Lynch: if you're good, you're right 6 times out of 10. If you're good, right? One of the better examples out there is David Gardner from The Fool, who's got a strike rate of like 3 or 4 out of 10, but has smashed the market. Strike rate doesn't matter in this game. So I want to put that out there, because if you're coming to this game thinking that if I make a mistake, it's a disaster, I've done something wrong, you're thinking about it wrong.
In my view, the reason small caps or growth investors, if we want to like have a bigger group of people where this is hold true, growth investors, of which small caps are subset really, because some people value small cap investors, but most successful small cap investors look for growth. So those people, like, part of how I think you can get an excess return is that the thing that's hard to do for people is to take losses and also then hold long enough for the winners to like truly compound, because there are 2 bits that are hard to do. First of all, people don't want to like be taking the loss. So they don't like this sort of make 10 kind of high risk bet process, and then you're going to like lose on 6 of them. And then the other thing is that what people don't like is they don't like to then have that one stock that's 25%, 40% of their portfolio, because that's the one that's doing really well right now. And especially as you're starting out in this process, the first time you have that first really big winner, you're going to have one stock that is like the main game in your portfolio for a while. And then over time, and it takes a long time, but over time, after 10 years, you might have 2 winners, 3 winners. So then you start having a few big stocks that are vying for huge influence in your portfolio. And people can't do that. Fund managers can't do that for their own, because of their own set of incentives. And that's why there's like excess returns available in this activity.
Dude, Warren Buffett can't do it, right? Like, so let's be real. And also, you're not wrong because the share price has gone down necessarily. Like, I've suffered through all kinds of drawdowns. In fact,
you're the master of this, though. You do this more than me. So this is like, we've touched on this before, but like, you'll ride catapult all the way down and then back up. Whereas I like sold it when things were going back down and never bought it back on the way back up. And then it's actually a similar story with Laserbond, right? So I recommended that the recommendation price on the close after the recommendation went out was 81 cents. And then when I sold it, the close price after the sell recommendation went out was 75 cents. So what essentially happened is I did it got cold feet because things weren't going according to like what I needed to see. Sold it, and then the share price has halved from there. But now it could be on the way back up. And funnily enough, it's still, I'm open. It's 53 cents now. I'm open to changing my view. I don't think I will, but like that creates its own bias, right? When you do this, when you buy something and then you sell it, it's very, very hard to go back into that stock now as a bull or bullishly, which is why when I have had this sort of history with a company, I tend to try to get somebody else in the team to cover that stock from now on, because I feel like my psychology is very muddied once that's happened to me.
Yeah. Yeah. And it's also really irrational when you think about it, because we all sit here going, I want to buy a really good company at a really cheap price, right? And it's like, well, think about what that means. I mean, it's an impossibility. If everything is going great guns and everyone recognizes this company is brilliant, you're not going to get it at a cheap price. So how do you get a great company at a cheap price, or even a good company or an adequate company at a cheap price? Got to have some hairs on it. It has to have it. It is a prerequisite to have some hairs on it.
All right. Well, so the psychology of it's important, and that's the sociological background. A lot of investors would have been through that journey. But let's just look at the recent announcement, which is the small cap news. So on the 25th of July, Laserbond announced that its second half FY 2025 net profit before tax would exceed guidance. It was going to be 3.7 million, and that's up on 3.1 million in the prior corresponding period. The revenue was in line with the guidance range. So essentially what's happened here is that they've had, stronger than expected profitability, reflecting a notable improvement in gross margin performance. This was mainly driven by increased workforce productivity, as recently onboarded skilled staff became fully integrated and effective after initial training and development. Additionally, cost optimization measures implemented earlier in the year began to deliver tangible benefits in the second half, supporting our return to stronger profitability. So basically, it seems like they've
Please translate that for me into plain English.
Yeah, they've tightened the belt and stopped investing as much in growth, right? Because previously they were training new people and there was sort of a cost associated with that. Now, from what they're saying, they're not training so many new people, and more of their workforce is productive and making a profit for them. So they've probably, and they also, this was preceded not long before that by a decision not to continue investing in US expansion. And so essentially that's in the same theme, that they're like investing less in growth to help improve profitability in the near term. So at least that's working.
It's just so fun to watch the narratives. Like, I'm going to give the business a whole bunch of credit here, okay? And I'm also going to try and zoom out a bit. You have this wonderful little family-run business that effectively starts out of a garage back in the 90s. Actually, I think it was even before then. It was doing some stuff. And, from a couple $1 million in revenue to a listed company doing $41 million in revenue, like it's an incredible achievement. You've got to put all of that in context. Now, anyone who's run a business will tell you that nothing ever goes up in a straight line. And so what has happened here, and this is one of the real perversities of being a listed company, is because you get to be a listed company because you've had some success and you've grown to a size and scale where that becomes a tenable option. And then the incentive set changes. You go from a family business whose main priorities are resilience and longevity, and throwing off cash to make the investment worthwhile. This is going to be a shock for most people in the modern era, but that's what business is about, right? It's actually about generating value for your customers and being rewarded by a profit for doing so.
I thought it was about generating clicks.
Now it's about pushing the share price up. And you might go, well, hang on, Andrew, isn't that the same thing? Isn't the market a voting machine in the short term, but a weighing machine in the long term? And yes, it is. Yes, it is. But the incentives are such, and the timeframes and the focus is narrow enough that it's always about, give me the growth now. Tell me how much you're going to earn next year. You said you were going to earn 41.7, but you delivered 40.3. What's going on? You've got to rationalize this. Or what about this? Your competitors are going into the US. Why aren't you going into the US? And et cetera, et cetera, et cetera. So everything really changes. And so, things didn't go well in the US. Show me a business that hasn't done some kind of growth initiative that didn't work out. Was it wrong to pursue that growth initiative? If it was a viable, reasonable opportunity, hell yeah, go for it. It didn't work out. Okay, that happens all of the time. But on the market, you are pilloried for that kind of stuff. Let me hasten to add, there is a difference between a company, and there's a lot of these in small cap land, right? So it's understandable people have a cynical view because this is the norm, where you have serial people who just continually overpromise. And really the only product is hype. And it works. It works remarkably well because it drives share prices up. It allows you to continue to enjoy your very juicy salary and all the perks and options and stuff that go around with that. And you're only there for a 3 or 4 or 5 year term. So you're going to cash out and bail before any of the long-term sort of issues start to sort of surface. So I'm just trying to put all of this out there just to sort of say, I actually think this is a really good business which has delivered a remarkable success over its time frame. I mean, anyone out there listening, imagine if you and yourself and your friends or your family had done this, going from a garage to $40 million in revenue over a few decades. It's an incredible achievement. But yeah, they've hit some speed bumps along the way. So what you need to do, the first thing you always need to do, and just following on from my earlier point that you never get a bargain without some hairs on it, you have to distinguish between, is this or these recent problems, are they structural or are they cyclical? That is there something fundamentally wrong with the business that's going to be very, very hard to pull it out of this nosedive? In which case, no, any price is probably too high. Or is it a business that just either A, got a little bit unlucky due to broader macroeconomic considerations or something that a competitor did, just, external shit happens kind of stuff, which is normal in business. Or perhaps even that management got above their skis and they made a few bad decisions. I'm super understanding and compassionate with that. But as long as, and here's the key point, it really wasn't a result of blind ego and hubris and a cynical ploy to push the share price higher. If it was genuinely, hey, we thought this is a good idea. We got a really good tech here. It's really expensive to go build this out over in the US. Let's maybe license the technology. I actually spoke to Wayne, the CEO and founder, not a few years ago when he was talking all about this. Now, at that point in time, you go, that's a really good idea. That seems like a really good idea. It's going to be much more capital light than doing it yourselves. It's going to allow you to tap into a different market, and you're going to have insane margins because you're really just selling the technology and a little bit of know-how. You don't get the full benefit of whatever success is out there, but the return on equity component of it is really good. Now, it didn't work out. Well, let me back up a little bit. It didn't work out yet. But of course, if it doesn't work out immediately, it's a disaster. They were scamming us. They lied. Let's crush the share price. And to me, this is, and I'm giving this sort of outline, this view here, because the way I see it is that this was a stumble. Now, we could debate all day long as to how obvious a stumble it may have been in advance. I don't know if it was. But I don't see anything wrong with the business.
I think that the technology licensing part of their business has been a genuine stumble, and that's or like a genuine bit of a mess up. So there was multiple times where they were like, we're expecting to deliver this, to put on. So they get paid once they actually get their system up and working at some other person's workshop where they've licensed the technology, for 2 or 3 halves in a row, they were for a couple of years in a row, they were continually saying, we're expecting this technology revenue to land in the next half, essentially, or by a certain amount of time. Yeah. And then they continually did not deliver on that. Yeah. And clearly there were technical problems with delivery. It was they couldn't get a certain part, and then they just couldn't get it commissioned, and there was huge delays. And you have at the same time one of the original founders, the former CTO, the brother of the current CEO, criticizing the company on Hot Copper, and basically saying all sorts of things, basically criticizing their execution. And now his method and the way that he's gone about criticizing the company has definitely perhaps undermined himself in some ways. For example, he sold a ton of shares right before he started his criticism. Not right before, but he sold a ton of shares and then kind of continued to want to be treated as if he was like, I guess, an insider. Well, I don't. If that's wrong, I apologize. That was my impression. That was the impression I got. I was like,
But we don't know. There's been a
you
falling out.
Keep your shares and then stay on the board and stay with the company and be like, we have to change the direction. That would be a more effective way of changing the direction of the company than leaving the company and then going from the outside and criticizing on HUB24. That's my opinion, is that it would be more effective to stay in your role as CTO and like have massive influence over the company versus leave and then try and control things. So I don't know about that. And I can understand that you're going to lose control if you resign your position, et cetera, et cetera. But at the same time, some of the things that he says is, in my opinion, seems to be reflected in the actual results. Like there's multiple times they were just not delivering what they were supposed to deliver and what they said they could deliver with that technology stuff. And now they've kind of just let that segment completely die out, which is fine because
they were pressured to let it die out, right? Because it didn't immediately deliver. So shareholders who can't see beyond next Tuesday go, well, you wasted money. And this is the irony of it. Like, we want you to grow. Oh, you want us to grow? Okay. So I guess America's a big market. It's a good technology. Okay. So I guess you need to do that. You need to do that. Oh, it didn't work. Why aren't you focusing on cash flow and profitability? Operating cash flow is all we care about. Don't you know that? Oh, you don't want us to do the growth then? Well, not that kind of growth.
It's a marginal shareholder changes, right? Like this is when it was at like 80 or 75 cents, and then they like did some acquisition without really even announcing all the details of the acquisition. I was like, I've had enough of this, and sold it. And that I was initially in there as a long-term investor looking to have some patience with the business. But what I found was just the communication and of the journey, and there was just too many. Like,
I don't want to try.
It wasn't the quality of execution and even just communication about execution that I was looking for.
It's black. It's IR. Anyone out there working in IR, look in the mirror, right? Like you do absolutely no. I'm generalizing here, and it's like when I crap on about real estate agents. There's really good ones out there, but just the most of them are shit. And when it comes to IR, that is 100% it. They are so myopically focused on what the share price is going to do in the next 6 months. And all they do is undermine management credibility. And it's management's fault. I'm not giving them a free pass at all, Claude. It's management's fault that they listen to these idiots, right? Because you get the shareholders you deserve. And Growth Gauge made the point in his article. It's just like,
also, I think he's been partially proven correct, right? Because he's like, look, the share price is heaps lower now. And also what they're doing is focusing on
so it didn't work. It never does. When you need to give the guidance to the market. Okay. You need to make it sexy. Oh, okay.
But what I'm saying is what they're doing now is better. It's not better long-term necessarily, but in the short term, what they're now doing by cutting down on growth initiatives and trying to prove that profitability is they're showing the market. The shares got sold down to like 40 cents. Now they're only 53 cents. They're showing the market, in my opinion, how profitable they can be. And for the people that bought in at 40 cents over the last 6 months, they'll be like, this is great. Can you just show the market how profitable you can be? And the share price will go up and I'll make money. Because if they bought at 40 cents, then, show your profitability. The market goes up to even 50 cents, 60 cents. That can happen. And I guess the sociological cycle then is if the company can prove its profitability when it wants to be again, and say do 2 years of like modestly growing profit at around its current level of profitability, then its share price will be A, higher, and B, that's when it might be able to like sell the story of like, some other growth prospect essentially.
And the cycle
it's actually
repeats.
It's a bit of a cycle, but so where we are at the moment is in the most recent half. That was the first half that was like a significant improvement, right? So that's whopping in the second half, the 3.7 million in net profit before tax. That's way up on what we've been seeing from this company recently. And that's a massive improvement in margins.
It's quite a bit above the top of guidance that they provided not long ago, isn't it? I think.
So this is a return to the margins that we're seeing. So we were seeing net profit margins around 10% and higher in the sort of range of, I think it was about 2019 to 20 until, things started falling apart in 2024. So this is a return to those high level of margins. And if they can just do that for a year, the current run rate they're on is like they'll make maybe $5 million profit. If they can, it's reasonable to suggest they could make $5 million profit based on this second half if they just keep doing what they're doing in the next year. So $5 million profit at 53 cents share price. I don't think there's any, shares that mean that the basic ComSec market capitalization will be wrong, because that sometimes doesn't pick up on escrowed shares. I don't think we have that problem with Laserbond, and it's suggesting the market cap 62 million right now. So we're talking 5 million profit and 62 million market cap. It makes me want to be like, oh, should I check this? Because that's quite low. So yeah, ultimately, I basically think, that's like 12 and a bit, right? So if it just shows does 1 year of profit at 5 million and then shows 10% profit growth the next year, surely the market, forgetting the history that we've just talked about.
Oh yeah, the market will wet its pants and it'll fly up and it'll get silly. But the market's an idiot, and I'll tell you why it's an idiot.
It could be 18 times or 20 times.
Again, I'm going to zoom out here and forget about the stupid share market, right? So you've got a business in 2015. I've got it here. 10 million in revenue. Then the next year, 13, then 15, then 22, then 24, then 30, then 38, then 42. This thing is a staircase in terms of revenue. Now, the thing is, you've always got to remember with growth is, unless you are exceedingly lucky, it doesn't just appear. You don't just get this organic explosion in demand for most businesses. Although if you do find that, then that's something really special. You've got to engineer that growth, and you've got to lay the foundations for that growth. And so you're right. You're 100% right, Claude. If they just cut back on some of these growth initiatives, they start tightening their belt, they're going to see margins expand without necessarily the revenue expanding.
It can't necessarily go on forever, though, can it? But
no,
I still see the...
No, but listen to my point.
It.
Here's my point. My point is that you put me in charge of Laserbond. Oh, absolutely. If you want me to, if you structure my incentives appropriately, I will absolutely make sure that profit grows very strongly over the next few years. But I'll do it by strip mining the capital base of the business and by completely underinvesting for growth. And then you turn around and you're right. The market, wow, they've gone from 5 million to 7 million. That's like, in profit over the last few years. That's in 40% growth. That's incredible. But they've done no R&D. They've done nothing to
I see it happening, man. I reckon it's going to happen. I reckon the most likely base case.
And it's not a buy and hold. It's a short-term trade, which is fine.
Most likely base case for me is there's still more juice in the turnaround. This thing probably, if it could just, string together 2 good years, I could see it going to 80 cents, 90 cents again.
I do too. But after that has happened, after you've squeezed everything and optimized everything, then the market will be like, okay, now where's the growth going to come from? Margin expansion, and also that assumes that
people are going to believe the story in a couple of years. People might 100%. Not, or they might not achieve that.
100%. So my the only point I'm trying to make here is, and this is the negative, is that you've got people in the ear of management who shouldn't be there, and management who should by this stage know better than to listen to them and just play it straight. You think about some examples on the ASX that might be like this. ARB springs to mind. Founder-led, 2 brothers, never really give much guidance, don't do much in terms of press coverage, just get on with the business and let the numbers speak for themselves. How's that worked out? Really well. Let's look at any other business that just goes from hype to hype to hype, and we're going to do this and we're going to do that, and they never does. So what I'm trying to frame up for here is, and I'm not trying to get away from the detail of the most recent announcements, but it's one circuit around the sun, and it fits that what happened in that period fits within a broader context, the history that we've discussed, and what the business is focusing on going forward. For what I want for a business, right? If this was, forget again the share, I own this thing outright. What do I want? I want you to absolutely maximize this in terms of efficiency, productivity, operational pedigree. I want you to run it really, really well. But wherever there is a sensible opportunity for longer term growth, I want you to restrict the money you would otherwise give to me, and I want you to make that investment knowing that is going to impact me in the short term, but is going to reward me greatly in the long term. Most investors do not get that. I don't know, it seems really obvious when I say it out loud to me, but most investors don't get it. F them. Like, you don't want them. You don't want them as shareholders because they will be the ones that are there just as a pure distraction. But to your point, in the way that you open this podcast, there are lots and lots of really smart, patient investors out there that represent, sound quality capital that will be partners for the long term. They're the ones you want to attract, right? So what I hope the company is going to do, on just to go back to your earlier point here in terms of the margins. So Wayne made has always been consistent on this. Their process.
Let's just
is
have a
really
moment to
niche.
appreciate that rabble rousing speech you just gave us, though, about. Anyway, now go on. Yeah,
I'm just so jaundiced and cynical in this game now. And honestly, I think once you can sort of
you had a point about margins you wanted to make.
Once you pull back the curtain, there's actually a great edge to be had, I think, with that view. So what happened here? So the extremely niche technology, it takes a while. They have, for the life of them, just cannot get what's the trade called, fitters and turners, and the people with the appropriate skill set to operate their machinery. So they've got to go overseas, right? They've got to bring in immigrants to do it, and then they've got to train them. Now, it's not as though the business over here is just doing its thing and on the side.
Because all the Australians just want to be on YouTube or whatever and not have to actually do any real work.
Well, we're flipping the property, my friend. We're flipping the property.
Exactly.
We're not going to do any wealth creation.
Why work when I could just own 3 investment properties?
Oh, and if I'm really smart, I'm going to engineer it so I bleed cash every year and not have to pay any tax. Like, isn't that genius?
Magic.
Don't get me started, dude. So I've lost my point.
The margins are good under all that.
The margins are kind of good under all of that, but also, I was going in another direction there. It's just Claude, you've thrown me off. You've thrown me off track.
But it was funny though. It was worth it. It doesn't look anyway.
Oh, sorry, no,
right.
I remembered. So when these new people are being trained, and it's a lengthy process, the people training them are the people who know how to do it. So you've got your trained workforce, your highly skilled workforce, right? And before, they were spending 100% of their time at work being productive. That's not the right word. Yeah, being productive. Not that they're not being productive now, but 30% of their time is now dedicated on training up Barry, who's just fresh and green, doesn't know his ass from his elbow. It's like, we've got to get Barry up to speed, and we're going to, in 6 months of, rather than me just producing at maximum capacity that I can as a skilled technician, I now have to dedicate all of this time to Barry over here. Now, at the end of that process, I've now got more staff who can dedicate 100% of their time on being productive. And so that's why you get that big jump. And he's been saying it, that we're going to do this. It is a clear bottleneck for our business. We just don't have enough people. That's one of the key bottlenecks. So what do you do as a business owner who's thinking beyond just the next 6 to 12 months? Like, let's get some dudes in. We need some staff. And you know what? Our entire value proposition relies on a good service delivery here. So we need to make sure that they're good. And we've done that. And now it's happened and it's shown the results.
Quite frankly, I like the angle of leaning into their services division. That's the ones that's been growing this entire time. I think it's good that they're growing that one where they've got the demand. So look, I think,
and that's the core of the business, right? It's always has been.
As is often the case, we've just gone real deep on the first stock I wanted to cover. And,
I'm sorry.
No, it was worth it. It was good. Like,
I'll finish. I'll round it. We have not even got to. I'll just round it out very, very quickly here. I think what you've got here with Laserbond is a really good case study in a company who's underneath it all, it's got a real product. Is a profit of really, like when you take away all the growth initiatives, a really high margin product with a lot of opportunity to grow. It's just that they need to invest for that growth. That's just what needs to happen. And sometimes when you invest for growth, not everything goes to plan, things don't happen as quickly, and at the same time you're being impacted by outside macro forces. And what I'm saying is, and it's easy to say with hindsight, but Laserbond at 40 cents was a bargain, right? And that's what you want to look for, is the business that is actually pretty decent. They've made some stumbles, and the market just can't get past the fact that they missed guidance by 0.4%. And you've actually got an opportunity now to buy the exact same thing at a 40% discount to where, in fact, gosh, more than that. And I would suspect for me, the thesis here is that they just continue to keep doing what they are doing, hopefully quieten down the noisy shareholders who don't know what the hell they're talking about, and just get on with what they are doing. If they were to do that, I would substantially increase my holding in the business. I think it's a good business, and I think it's cheap, so I've still got some. But the one thing that stops it being like a much heavier investment is I'm not sure that they've got the ability to stick the middle finger up to the market and say, we're doing it our way. You're either with us or you're against it. And that is an easy thing for some dude on a podcast to say, and it's an incredibly difficult thing given the incentive structures for a listed CEO to say that. But if they were to say that, it would change everything for me. And I think you would find here, you would have a decade-long compounder that would seriously grow your capital over that period if they could just get on with the focus, let the family history sort of reside into the background, let a few of the stumbles in the background, learn the mistake not to telegraph every expectation 3 months out and to overpromise, all that kind of nonsense. Get rid of that, and this is a very different proposition. It's a good proposition now, but it'd be a great proposition if I could be confident in them going in that direction.
And Andrew, do you own real life shares in Laserbond?
Yes, I do. Yeah.
Okay. Good. Important disclosure. Yeah, there we go. So,
is that as opposed to dead shares, or?
No, he was talking about his Strawman portfolio.
Gotcha.
Which is also what he cares about. But it's not always exactly the same Strawman portfolio and real life shares.
Play money is easier to be. It's easier to be high conviction with play money than it is with real money.
But he also has real life shares,
Definitely.
which is why I ask, because it's important disclosure. But I don't, and you don't do. But Growth Gauge, who wrote that article, did at the time he wrote the article anyway.
Yeah, and I'm
talking to me
too. Yeah.
No, I don't own Laserbond.
Yeah,
no.
good. I just wanted to say, okay, great, Andrew, that was awesome. I honestly, throughout this whole process talking about Laserbond, it makes me honestly want to even, it does seem like there's a sort of not the long-term beautiful buy and hold forever thesis there for me, but there's some decent, it's a prospective stock. Anyway.
Not unless you could be confident of a change of mindset, I think, with some of this in how they react and deal with the market.
It's still perspective, though. It's an interesting story. Okay, now moving on to one that you've done some work on, Patrick, and in fact, probably by the time this is up, your article about Praemium will already be on the website for people who want the deep dive. So let's just have the high-level discussion on Praemium. Can you just kick us off, Patrick? What does Praemium do, and why are we bothering to look at it?
Yeah, look, I'll just go disclosure first. I do own shares in Praemium and did so from before I started on this article. But look, the most important point is one around price and value, right? So Praemium operates essentially in the same market as Netwealth and HUB. So that is providing investor platforms primarily for the clients of financial advisors, but it can be individual retail clients as well. So their core business is their custodial platforms and SMAs, which is separately managed accounts. That is very similar to the Netwealth and HUB businesses. They've also got another business which is non-custodial, which is probably more analogous to something like ShareSite in that they don't actually hold the assets on the platform. So it's more just about reporting and administration and things like that. So that's kind of the easiest way to think about the two sides of the business. A really important distinction is that one of them, the non-custodial, you get paid by number of accounts, whereas the custodial, you get paid by assets under management. So I think that is actually really critical to note. So they operate in that same market as Netwealth and HUB. And, I like those businesses. I own Netwealth. And it basically the story there, I won't spend too much time on it because I've written about it before and I think we've spoken about it as well. But fundamentally, the story is there's a bunch of legacy platforms that have enormous assets under management. And they're, Colonial First State, Insignia, AMP, BT.
It's a real who's who of mediocrity.
Yeah, exactly.
And screwing over ordinary Australians, isn't it?
Yeah. So those
Record, if any lawyers listening to this, I do not endorse.
I'll see you in court, my friends.
Yeah.
I will die on this hill.
And do not send us letters, please. We didn't mean a word of it.
Yeah, because you have to hide behind your lawyers, don't you guys?
This is performance
the numbers,
art, gentlemen. Performance art.
But basically, those platforms have been bleeding, funds under administration for years now. But they're just so well. But they're enormous. Like Insignia, which I believe has recently been bought out, has like $223 billion of assets under management as of the last update. Now, there's kind of a middle ground one in the market here, which is Macquarie. That they're not really a legacy platform, but they're not really one of the new upstart independents either. But they are actually gaining market share and funds under administration. So basically, Netwealth, HUB, and Praemium to an extent have been just eating the lunch of these big platforms, and they've grown a long way. But there is still a lot of funds under administration that they can get. And these are great businesses because...
All right, I got to jump in there because this is one of the key arguments around Praemium, right? So I think you're giving a great, example of the scene setting there, what they do, etc. But just looking at why we're looking at Praemium, right? Can you just tell us about, what's the valuation differential between HUB, Netwealth, and Praemium, which, whilst I think of it, I own shares in HUB. And the reason is because my style of investing is like I'm looking at quality. I lean biased towards quality. So I'm like, I want the best one in this one. Whereas the argument for Praemium is a different kind of argument. So like, give us that.
It is, yeah. And but by the same token, I feel the same about Netwealth. I think HUB and Netwealth are fairly similar in terms of quality. But yeah, so essentially it's a valuation gap argument. So this is based on FY25 consensus estimates via Morningstar. So Netwealth is trading at 78 times earnings. That's as of like lunchtime yesterday. HUB at 94 times earnings, which is honestly just very, very premium pricing. By contrast, Praemium sits at like 23 times. When you look at the Praemium also aren't monetizing their assets under management as effectively as the other two. So I think there's room for uplift there. So if you look at it, the HUB and Netwealth have got around, call it 90 to 100 billion roughly of FUA, whereas Praemium sits around 30. These are slightly old numbers because we don't get the full industry updates very often. So, in terms of funds under administration, they're roughly around a third. But then when you look at the market cap, it's like 9 billion each for HUB and Netwealth, and Praemium at 400 million. Now, there does deserve to be a quality premium there for Netwealth and HUB. I don't question that whatsoever. They are better quality businesses, and so they just deserve to trade at a higher price. But you're literally talking about a 3 to 4 times the multiple that they're sitting on. And I just think that is too great for what the quality gap is.
All right.
I imagine you may disagree, Claude, and I'm curious to get your thoughts there.
That, but I don't know about that, whether I disagree, because essentially I don't need to actually take a view on that because I just own shares in HUB24 from much lower prices, and I bought low prices, and I'm not calling it a buy today. But I own shares a significant position as a result of buying previously. And my view could just be, I don't care. Because the issue that I wanted to bring up, and in fact, the key insight that I wanted to bring up is something that I got from the Strawman interview of the HUB CEO that was a little while ago, Andrew. that I watched via your platform.
About a month ago. Yeah.
Mr. Nice Guy interviewer. Oh, tell us how good your company is.
You know what you do? Here's a little peek behind the curtain. If I went all Lee Sales, right, or the CEO, what are you doing? Explain yourself. You know, A, I'm never getting a guest come on again, right? B, they're gonna like clench up like a you know what, and they are not going to like say. If you want people to hang themselves, you give them enough rope.
No, you're a good interviewer, man.
You're an Andrew Denton fan.
I'm an Andrew Denton fan, and I just think when it comes to like you can have you must have a private view of these things, but it's like I'm not there to score points and dunk on this person in poll. I want to know what's going on. And if you just let them talk and you feel as though, and you can try and make them feel like they're in a safe space, they'll tend to overshare. And like, so what do I want to do here? Do I want to score points? Or do I want to like get them to reveal something perhaps unintentionally? So there's my high level strategy. and yeah, okay, I'm a little sycophantic at times, I admit.
But if I do think there's a second key part of the thesis as well, and it's one about improving quality. And for me, if I'm buying a company that's a bit, that looks relatively cheap, I want to see.
Point, and this ties totally what you're saying, right? Is the point that he said in Andrew's interview was that clearly the market multiple is most dependent on your ability to grow FUM and to grow market share, because they do think that this market share is valuable. So what the market's giving that high multiple to HUB24, the reason that it has the highest multiple of historical profits is because it's the one that's doing the best to gain market share. And if you look at the Hub, and look at net wealth is also gaining market share, but Praemium not to the same, well, not really, is essentially my argument, which is the hook. Now, what I thought was really cool is that the new CEO, he's relatively new, right? And definitely, how long's he been there? Because last time I looked at the stock before this, it was a different CEO for sure.
I don't. Yeah, I think so. Just going. I'll be honest. I haven't gone back.
I looked at it.
I'll be honest. I haven't gone back and looked through all the historical announcements, but
I've been doing.
I think
ASX
I've got Anthony being there 4 years, 8 months.
Yeah. So I'll tell you this: in the same month that I recommended RPM Global years ago in like 2016 or something at 40 cents, the other stock that I'd been considering recommending was Praemium at like 30 cents or something like that. 30 and then all these years later Praemium's doubled, but the Hub's up 10, way more. And that was when I first looked at Praemium, and it was absolutely very messy compared to how it sounds and seems today. I definitely prefer the current CEO than the CEO that was the CEO 10 years ago, for sure. He seems to make sense to me. And I really liked how he put his finger on this fact that they need to grow FUM. They need to go or show market share growth, right? And the problem is, in my reading of it, reading between the lines, I liked how he just actually said the thing they needed to do. And I agreed with that. And I think the reason that's challenging for them is that their platform's not as good as the other guys. I don't know why or how or whatever. That's just what I think, because I think it's the most obvious reason that they're not growing FUM as much. And that is borne out by the reason that I wanted to talk about it today on this podcast is because I wanted to do, the upgrades, the quarterlies and all that kind of stuff. The most recent data shows in the most recent update that they gave, they once again had poor inflows, quarterly net inflows of 152 million, excluding OneView. I think, exactly. So that's, and then I think the OneView was a massive outflow as well.
So can I explain that? Because it's a little bit, it took me a while to get my head around what's happening here. So first of all, there's 3 different platforms that they own. Eventually that will be 1, but currently it's 3. So they've got PowerWrap, which they acquired through an acquisition of PowerWrap by a script takeover, I don't know, 4 or 5 years ago, something like that. So that is basically their legacy platform. that is what's got the highest amount of AUM, and I don't see that as having a great future. And in fact, I think they will eventually roll all of those clients over and close that product. They've also got OneView, and the reason there was a big rollout of OneView is because they were putting that AUM went from OneView to their new platform, Spectrum, which they've been developing for several years now. So that only went live in the December quarter of 2024, and excluding that money that's come over from OneView, they have added, around 900 million of AUM, in addition to the 2 billion that they've rolled over from OneView. Now,
wait,
if they were
just, are you talking there? What time period are you talking? They've added that
since they launched it in the December quarter. So there were net flows of 69 million in December quarter, then 440 million in March quarter, then 339 million in June, and that excludes the money that's come over from Power Wrap. So everything you said, I agree with in relation to Power Wrap and also to OneView. But Spectrum is the product that they've been working on to try and compete with NetWealth and HUB. Now, I would love to hear from any financial advisors who have used this product, but I know that is the standard that they're holding themselves to. So if there's any financial advisors out there listening to this who have actually used Spectrum, please let us know in the comments.
Yeah, do let us know, because if it's actually good as HUB and NetWealth, and they can, start taking share again in the overall market at some point in the future, I do think exactly like what the CEO said. Like, if they do start growing organic market share, that's when the multiples will start to probably re-rate towards HUB and NetWealth. Now, even if HUB and NetWealth do come down because markets go up and down, these stocks are notoriously volatile because they're linked to the market, right? A lot of them get some portion of revenue essentially as a percentage of FUM, or funds under the platform, and it's a tiny percentage, but still, if that amount goes up, then so does their revenue. So as markets and asset prices go up, they fly, but then when assets and market prices come down, they take a dive. I think it's these are the classic buy a dip stocks. The more I've owned HUB, the more I'm like, just buy this one when stuff is freaking out. Like, this is, I think, one of the few stocks that I actually did buy when we had that panic day or whatever.
It was the same for me with NetWealth, and I agree.
Yeah.
I think both are great companies, by the way.
Yeah. Anyway, look, I diverge. It's different now. It's bounced back, etc., etc. All right. Look, I think that we've touched on that, and I want to move on because this is getting long now. And in fact, do you know what? Let's just leave it there. This is the perfect length already. So we can do Australian Ethical, in which I own shares, next time. Actually, no, I'll do it quickly. So
just give us the update.
I just want to do the update, basically. So the most recent update that it had is that it has grown its 34% full year FUM to a record. It's got 34% full year FUM growth to a record high of just under 14 billion, which is just amazing, because when I remember this was $1 billion FUM. But for me, the bit that matters, the bit that I actually care about, is the superannuation growth, because essentially the rest of the business is just some sort of standard fund manager to me. But the Australian Ethical Investment Superannuation is a really sticky product that has disproportionately younger people, and they're people that not entirely there because they wanted the most money possible. They also liked the philosophy of Australian ethical investments. So I reckon that's a good business that's likely to grow for a long time. And what I want to monitor is the quarterly net inflows into that superannuation. And that was what was a good result in this quarter. And that is so crucial to the long-term thesis, because the whole point was that in the last couple of quarters, they have been doing this big transition from some of their back-end systems, and that they were restarting their marketing, and that you would see the results of it this quarter. So I was quite nervous, and the market was quite potentially, I don't know what the market's thinking at any given time, but I think the problem was that they'd sort of stopped winning new clients for a little while, and they were just getting their inflows from their existing clients, which is still a good business, but it gave you a bit of a snapshot of the business at, I guess, a lower ebb. And now it seems like their things are moving up again in terms of them actually getting new clients, which is what I'd like to see. And yeah, so as a result, yes, the share price is up, but I think it was probably worth saying is up based on some genuinely good confirmation that what the company had previously said is starting to occur. So that is a reasonable reason for the stock price to go up. You can argue about the quantum of it, but the point is that was good news. So yes, full disclosure on that, I do own and have recommended Australian Ethical, but for the time being, I thought it was a good update.
All right. Well, I guess we should probably wrap it up there.
Cool. All right. Sweet. Thanks, guys. Thanks, Andrew. Any last words?
No. Sign up to a Rich Life.
Oh, thanks, brother.
And Strawman.
And Strawman. Yeah, we definitely enjoy. I always check Strawman to see if you've done an interview of a company I'm looking into. So I love it when you have as well. So, cool. Not to mention idea gen on the Strawman list.
And anyone. You don't have to say all of this just because I said something nice about a Rich Life. It has a pretty good. No, it's like if you look at where the content gets created in Strawman, it overlaps. It's exactly the same kind of people. It's genuinely interested people that kind of enjoy the research and the problem to solve of tracking companies, and that understand that one of the few ways to get an advantage is to actually just follow a company over time. That's how you're going to be able to predict how good a certain announcement is. Sounds like work.
Yeah, well, the thing is,
just tell me what number's going to go up, dude.
It's just some people need hobbies, you know what I mean? And that's how it started for me.
Sell low.
Like I was studying a law degree when I started investing. I thought I was going to be a lawyer, but yeah, didn't
Lucky
work
for
out
us,
that
you
way.
weren't.
The hobby took over. So anyway, cool, good times. Thanks for listening, everyone. And send us your suggestions and ideas, and we love all that stuff as well, and like and subscribe and comment. Yeah, we're definitely going to keep on trying to build the YouTube and the podcast over time, so definitely appreciate all the feedback we get and ideas. This whole Praemium discussion came out of a suggestion from someone, didn't it? So that was good.
Nice
one. All right, see you guys.
Thanks, guys.
Cheers.